name's Rebecca Wilkinson and I'm a Corporate Tax Senior Manager here at Menzies. Today I'm going to give you an overview of the various corporation tax measures that are dependent on a company's size. Company size can determine not only the amount of tax a company has to pay, but also the timing of those payments and whether additional tax reporting and governance is required. The important thing to note is that even small companies which may at first appear not to meet the various size limits could be caught if they are part of a larger group. All companies in a group structure should therefore ensure they have sufficient information on the wider group to enable them to determine whether any of the tax regimes apply. The table which you can now see summarises the different tax measures that depend on size, and it also provides the relevant size criteria in each case. The measures can be broken down into different subgroups, which I'm going to talk you through now. First up, we have size measures that are based on profit. These are the quarterly instalment regime, the loss relief restriction and the interest restriction. The quarterly instalment regime determines the timing of tax payments. To assess whether quarterly instalments apply, it's necessary to divide the taxable profit limit of 1.5 million by the total number of companies in the worldwide group. The key here is to assess how many companies to include, which could be difficult where group structures are complex. For companies moving from a single tax payment to quarterly instalments, early identification is key to help manage cash flow and mitigate late payment interest. Moving on, the loss relief restriction is fairly new and will come into effect on the 1st of April 2017. To assess whether any restriction applies to the use of tax losses, it's necessary to add together the taxable profit of each UK company in the group to determine whether the total meets or exceeds 5 million. Companies that are part of a larger group need to be able to identify all other UK companies in the group and their taxable profit in order to determine whether the loss relief is restricted. The utilisation of losses is an important part of tax planning, so having an awareness of potential restrictions can help manage group tax liabilities effectively. The interest restriction will replace the worldwide debt cap on the 1st of April 2017. The application of this measure is based on the net level of UK interest. Where the total net interest expense of all UK companies in a group is 2 million or more, the tax deductibility of the interest will be restricted to 30% of group EBITDA. To ensure that planning can be put in place to maximise the deductibility of interest charges, it will be necessary to have accurate information on interest payable for all UK companies and on group EBITDA. A number of tax measures are based on the European measures of small, medium and large companies. In summary, these are the dividend exemption, transfer pricing, diverted profits tax, worldwide debt cap and research and development tax relief. The limits are all measured on a whole group rather than on an individual company basis, so access to consolidated group data is key. For all measures, the starting point is to look at the number of employees and then the turnover and balance sheet limits. For example, a company will be large if it has 250 or more employees. However, if this limit is not breached, it will also be large if both the turnover and the balance sheet limits are exceeded. For the dividend exemption, the applicable rules depend on whether a company is small or non-small. Companies will need to assess which set of exemptions apply to them in order to determine whether any dividends they receive will be exempt from tax. Transfer pricing, diverted profits tax and worldwide debt cap can generally only apply to large companies, but with transfer pricing there are exceptions, so any company transacting with connected companies should seek advice as to whether arm's length rules apply. The diverted profits tax came into effect on the 1st of April 2015, and this one only applies to large companies with UK sales revenue of 10 million or more. The regime imposes an additional tax charge of 25% on companies that artificially divert profits from the UK, in particular by artificially avoiding having a UK permanent establishment. So companies that are at risk of being caught by the regime should seek advice to see if relevant transactions can be structured differently. The worldwide debt cap is going to be replaced by the interest restriction next year, so I'm not going to say a huge amount about it, other than that it is still currently in force and could cause the tax deductibility of interest charges to be restricted. If you are part of a large group and have finance costs, it's important to seek advice to ensure these are fully deductible. Finally, R&D tax relief is a valuable relief for many companies, but some people are unaware that the reliefs for large and small companies operate in completely different ways. The small company regime is more valuable than the large company regime, and some companies that qualify for relief under the small scheme may cease to qualify if they become large. For R&D purposes, the normal European size limits for a large company are doubled. The final group of measures concern tax reporting and governance. These are Senior Accounting Officer, Tax Strategy Reporting and Country-by-Country Reporting. The Senior Accounting Officer regime and Tax Strategy Reporting both apply to companies that are part of a group with UK turnover of 200 million or more, or a UK balance sheet total of 2 billion or more. In assessing whether the size limits are breached, it's necessary to add together the turnover and balance sheet totals of all UK incorporated companies in the group. Where there are different UK subgroups, it is therefore essential that information is shared to enable accurate assessment of size to be made. Country-by-country reporting came into effect earlier this year and could apply to any UK company that is part of a group with consolidated turnover of 750 million euros or more. The important point to note is that even very small UK companies could be caught by the rules, so identifying the group's ultimate parent company and assessing its consolidated turnover is key. Fairly significant penalties can apply for non-compliance with each of the reporting and governance measures, so if there's any doubt as to whether the rules apply, you should always seek advice. This has been a real whistle-stop tour of the different tax measures that depend on company size. The main thing to note is that no company should assume they're exempt from the regime and should undertake regular reviews, especially if there have been unusual transactions such as mergers or acquisitions during the year. If you're a rapidly growing company and think you might be near to breaching some of the size limits, please come and talk to one of our tax advisors who will be able to help you manage the transition.